So now that we know how to calculate the component costs of capital that a firm uses, debt, preferred, and equity, we can look at a measure of the firm's total cost of capital that incorporates each source's individual cost. The weighted average cost of capital, or WACC, tells us the average rate that a firm is expected to pay all of its capital suppliers. It represents the weighted after-tax sum of each individual source of capital the firm uses. Thus, the formula is WACC, the weighted average cost of capital, equals the weight of debt times the rate of return on debt times 1 minus the tax rate, remember because of the tax shelter that debt financing creates, plus the weight of preferred times the rate of return of preferred, plus the weight of equity, common stock, times the rate of return on equity. The formula for weighted average cost of capital is pretty straightforward and easy to calculate. Typically, we'll be given information about the firm's recent bond and stock issues, and to find the weighted average cost of capital, we'll first have to calculate the cost of each component of capital. Let's work through an example of this. So suppose a firm has decided to raise $10 million by issuing debt and preferred stock and drawing from its retained earnings. Current 10-year corporate bonds that have an annual coupon rate of 7% are selling for par. The current price of a share of preferred stock is $80, and the dividend is $6 per year. Flotation costs are equal to 15% of the current price. A dividend of $3 was just paid on all of the firm's common stock and is expected to grow at a constant rate of 5%. The current price of common stock is $25. If the firm's tax rate is 35% and it wants 20% of its capital to be debt, 35% to be preferred stock, and 45% to be common equity, what is its weighted average cost of capital? And so just so you know, this way of divvying up how we're going to raise capital from different means, so we want 20% to be debt, 35% to be preferred stock, and 45% to be common equity. This is called our capital structure. It's what percentage of our capital is going to come from what source. So first, to find our weighted average cost of capital, we need to find the required rate of return on each component of capital, so on each of the three components. So let's look at the firm's debt. Since its bonds are selling at par and the coupon payments are made annually, we know that the bondholder's required rate of return exactly equals the coupon rate. So the rate of return on debt is the 7%. So this was pretty straightforward. It could have been a more complicated bond pricing problem that would have given you some different coupon rate, maybe semi-annually, and a number of periods and a current price, and we could use all that information in our financial calculator to solve for the required rate of return. But if the bond's selling at par value and the coupon payments are annual, we know that those coupon payments and that yield to maturity is going to be exactly the same thing. So now when we look at the preferred stock, we have to take into account the flotation costs. So again, when we find the value of preferred stock, the required rate of return, we want to use this equation, and we have the 1 minus f in the denominator to account for the fact that the price that the investors pay for the stock is different than the price that we actually receive, because some of that money has to go to these financial intermediaries which are floating these new issues of preferred stock. So the dividend we were told in the original question was $6. The price right now is $80 and the flotation costs are 15%. So we plug all these in and we get a required rate of return on preferred stock of 8.82%. Finally, the cost of equity from retained earnings, well, we can use a discounted cash flow model. And here's the discounted cash flow model. The formula is the dividend in period 1 divided by the price in period 0 plus the long-term growth rate of the dividends. Well, we're given all this information. We just plug in the dividend of $3 and the price of $25, and we add the growth rate of 5%, 0.05, and we get a required rate of return on our stock, our equity, of 17%. So now we can directly calculate the weighted average cost of capital. The formula, again, is the weight of debt times the return on debt times 1 minus the tax rate, plus the weight of preferred times the return on preferred, plus the weight of equity times the return on equity. So we plug in all of our numbers, we wanted 20% of our capital financing to be from debt, so the weight of debt is 20%, 0.2. The return on debt was 7%, and the tax rate is 35%, so we just plug that into the parentheses, the 1 minus the tax rate. The weight of preferred, we wanted 35% of our capital structure to be from preferred stock, and the return was 8.82%. And we wanted 45% of our capital structure to be from equity, retained earnings. So we plug in 0.45 for the weight on equity and multiply it by the required rate of return of 17%. We find our weighted average cost of capital is 11.65%. So this is basically, on average, for every dollar we raise using all three of these methods, the average amount that we have to pay our investors back is going to be 11.65 cents. That's basically what this value is telling us. Sometimes the cost of capital for a single source will increase after some amount of money has already been raised with it. We can look at these breakpoints where the cost of one of the firm's sources of capital increases and calculate the average cost of capital before and after the cost increase. The marginal cost of capital, or the MCC, represents the cost of raising an additional dollar of capital at some point in time. So, it will change whenever we have a change in one or more of the component costs of capital. So in our first example, we had no limitations on dollar amounts that we could raise using any one of the three sources, the debt, the preferred stock, or the retained earnings. And so since we had to raise $10 million, it was irrelevant. The marginal cost of capital, the cost of raising one more dollar, would have always equaled the weighted average cost of capital because none of those sources increased. But now we're going to look at an example where one of them does increase, and we'll calculate the marginal cost of capital before that cost increase and after that cost increase. So let's do that in the context of our last example. So we'll keep all the same information, but we'll change just a little bit. So recall that we wanted to raise a total of $10 million, 20% of which was debt. So we needed a total of $2 million of debt financing. Our capital structure said we wanted 20% of the $10 million in debt, so 20% times the $10 million gives us a total of $2 million in debt financing. Now, suppose that instead of all of our debt having a cost of 7%, like we found in the previous problem, only the first $1 million does, and any amount after that will cost us 8.5%. What is the marginal cost of capital for each breakpoint in our capital budget? First, we need to find the level of capital where our cost of debt increases. We know that 20% of our capital budget, which we'll just call CB, is debt. We also know that when we have $1 million of debt, the cost of debt will increase. Thus, 20% of our total capital budget, we're going to set that equal to $1 million because this is the amount of our capital budget that's debt, and we know the cost of debt will increase at $1 million. So we're just setting this equal to find at one point of our capital budget will our debt financing hit this $1 million breakpoint. So when we solve for our capital budget, by dividing both sides by 20%, the 0.2, we get a capital budget of $5 million. So once our capital budget reaches $5 million, once we've raised that much money, our cost of debt will increase. That means for the first $5 million, our marginal cost of capital is, and we use the weighted average cost of capital formula, we just multiply the weights times the required rates of return on each component, but the components are going to change. So here we're looking at the first $5 million, and we know that our debt portion is going to be less than $1 million. So we take the weight of debt, the 20%, times the return on debt for the first $1 million, which we know is 7%, times 1 minus the tax rate, plus the 35% of preferred times the return on preferred, plus the 45% on stock times the return on stock. And we get the marginal cost of capital in this first half of our total capital budget from $0 to $5 million is 11.65%. For the next $5 million, though, our marginal cost of capital becomes the 20% in debt, but now the required rate of return on debt has increased to 8.5%. So we plug in 0.085 for the required rate of return on debt, and we multiply that by 1 minus the tax rate. The other two components stay exactly the same. we have 35% in the preferred stock. The rate of return on preferred stock is still 8.82%, and the weight on common equity is still 45%, and the required rate of return on equity is still 17%. So we get a marginal cost of capital in the second interval of our total capital budget equal to 11.84%. So basically, the cost of raising an additional dollar in the second half of our capital budget is higher because the cost of one of our components increased. The new weighted average cost of capital for the whole $10 million is just the weighted sum of the marginal cost of capital in the first segment and the marginal cost of capital in the second segment. So we're finding a new weighted average cost of capital. We want to look at the whole $10 million, and we know it's going to be different because the first $5 million cost a certain amount and the second $5 million cost a different amount. So since each $5 million is 50% of the whole capital budget, the weighted average cost of capital, we can just weight each marginal cost, each interval of $5 million, and add them together. So 50%, it cost the firm 11.65% interest per dollar we raise. And the other 50% of the time, it costs us 11.84% per dollar we raise. So the average cost for each dollar we raise of the entire $10 million is 11.75%. So what causes the marginal cost of capital to change? We've just seen that a change in one of the costs of the components will do it, but why do one of those costs change? Well, if the interest rate levels or tax rates change, these will affect a firm's marginal cost of capital. These are elements that are not under the firm's control. Changes in the capital structure, dividend payments, or investment policies will also affect the marginal cost of capital, and these are under the firm's control. And that's the end of part 2.